Cash cow, rising star, problem child, and poor dogs. Together, these are the components that form the foundation for the Boston matrix, which I would like to explain to you in this video. Hello and welcome. My name is Esther, and this is the so-called Boston matrix, also known as the BCG matrix, the product portfolio matrix, the growth share matrix, or the Boston box. The Boston matrix has been developed by a strategy and business consulting company called the Boston Consulting Group. The Boston matrix is a model which helps businesses analyze their portfolio of products, as it is an important tool that shows the market share or relative market share of each product and also the rate of growth within the market they operate in. If we take a closer look at it, we must look at two different axes. The vertical axis shows the market growth in percentage, so the increase in demand or turnover according to the product group, and this can be calculated by subtracting the total sales from the market volume and dividing this by the total sales. To see whether your company has a high market growth, you simply look if your market growth is higher than 10%. For example, making a turnover of 100 million euro in 1 year, and in the second year it is at 130 million euros. This means that your market growth is at 30%, and as this is more than 10%, you have a high market growth. On the horizontal axis, we can see the relative market share in relation to the strongest competitor. This can be calculated by dividing your own market share with the market share of your strongest competitor. At 100%, your market share is equal to the market share of your competitor. If yours is below 100%, then your own company sells less. For example, if you make a turnover of 30 million euro and your strongest competitor makes a turnover of 60 million euro, then you will have a relative market share of 50%, which is under 100% and therefore lower than the market share of your competitor. Considering these factors, a company can classify their products into 4 different components: the cash cow, the problem child, the rising star, and the poor dog. Starting with the cash cow. The cash cow is a product which has a high market share within a slow-growing market. These products tend to generate high profits for a company. This means that sales are relatively high without really having to invest in them in terms of promotion. There is always a strategy for all these products. The strategy for the cash cows is called milking, as we are trying to milk the cow and take whatever profits there are without investing more. You do this as long as it is possible, as you can spend this money on other products, like for example problem childs. Problem childs, also known as the question marks, are already the second component of the Boston matrix. These describe products which have a low market share within a fast-growing market. This means that these products might provide high profits in the future, as they have a good growth potential. The market is growing fast and they could therefore provide high returns if they would gain a higher market share. To do this, they might need heavy investment in terms of promotion, as the competition seems high. A business must consider whether this is worth it or not. Which also leads us to the strategy of the problem child, which is the so-called building. Here the company decides whether to cut the product out of the sales program to not risk any losses, or to heavily promote the product to make it more attractive and to gain a higher market share. The third component of the Boston matrix is the so-called rising star. This is a product that has a high market share and is also in a fast-growing market. That means that it is obviously attractive, but might need more promotion due to other competitors. The strategy for these products is called holding. This means that the company continues to invest in marketing to develop an even better and stronger market position, to make profit or to keep sales stagnant. Often, the money which is in excess of the cash cows is used to promote these rising stars on the market. Coming to the last component, we are looking at the poor dogs. These describe the products which are within a slow-growing market and have a low market share. This means that this product is neither generating a strong cash flow nor requires a heavy investment to keep sales high. If sales slip below the break-even point, then a company should consider the strategy of divesting, which involves selling the product off in order to prevent losses. So that was kinda a lot. Let us sum up what we have just learned. So, the Boston matrix is a strategy tool which a company can use to find out whether to keep and invest into a product further or if they should cut it out. On the vertical axis, we can see the market growth, and on the horizontal axis, the market share. Cash cows are products which have a high market share within a slow-growing market. Problem childs, or question marks, describe products which have a low market share within a fast-growing market. Rising stars are products with a high market share and a high market growth. And poor dogs describe the products which have a slow growing market and a low market share. So let us look at the Boston Matrix with the help of an example. We are a company that sells lamps, and we have 4 different lamps to offer. The first one is called Lamp Standard, which has a market share of 0.3%, and the market growth lies by 3%. The turnover is 1.5 million euros. The second lamp is the Lamp Deluxe, market share of 1.5% and market growth of 15%, and a turnover of 5 million euros. The third lamp is called Lamp Standard, with remote control, and has a market share of 0.6% and a market growth of 12%. The turnover is 3 million euros. The fourth lamp is called Lamp Deluxe, with a remote control and a market share of 1.8% and a market growth of 8% and a turnover of 6 million euros. If we now transfer this onto our Boston matrix, we would be seeing this. The products can be drawn into the matrix with a circle. The size of the circle depends on the amount of turnover these exact products make. Just pause the video and take a quick look at it. The first lamp, L1, had a relatively low market share and also a low market growth compared to the others, which is why it can be seen as a poor dog. It's the smallest circle of them all, as it only makes 1.5 million euros. The lamp L2 can be seen as a rising star, as the market share is relatively high and the market growth is above 10%, which is also why it has a high market share. The lamp Standard with remote control L3 can be seen as a problem child, with a relatively low market share but a high market growth of 12%. And then we have the Lamp Deluxe with a remote control, which can be seen as a cash cow, as it has a relatively high market share and a low market growth. As we have learned now, a Boston matrix helps companies to consider growth opportunities and to help them plan the future a little bit better. However, the Boston matrix also has some limits, as only 2 factors are considered, which are the market growth and the market share. Factors like the dependency on other products aren't considered. Just like some smartwatches tend to depend on specific smartphones, so if these specific phones are being cut off, then the watch might also slip in sales. Also, the factor of uncertainty isn't considered, as not every product automatically follows its typical life cycle, as the market share, for example, might also depend on certain situations like management problems or changes in the state of economy. This is why it is important to not only consider one tool to analyze your products, but also others, like for example the product lifecycle, which is also a strategic tool that refers to the length of time a product is introduced to its customers until it's removed again. Both are important steps into the planning process of a company. However, you could say that the Boston matrix is the one that is especially useful for larger businesses with many products, as it helps to look at their product range critically. The product lifecycle is more to help small companies with 1 or 2 products. So that was the concept of the Boston matrix. I really hope that you enjoyed the video, and I also hope that you understood how to use the Boston matrix and which strategies come with it. See you next time.